Joe, we're chasing 50K on the Dow. We're chasing 7K on the S&P, and the futures are outrunning the markets today.
Well, the March futures are now trading 7,000. They've done so here in the last 20 minutes, and that's the expectation that the market continues to move higher. And I think the price action over the last 4 days is indicative of that. The market seems to be going to different areas very tactically, trying to find opportunity. Today, it is about software. Finally, the long-awaited mean reversion. It appears in 2026. You have names like Datadog, Synopsys, Cadence that are moving higher. IGV is higher on the day. I would also focus on Microsoft of the Mag 7. That's the software name that I think if we get a continuation of this mean reversion that you want to look at. But I think the message over the first 4 days is the market's not running away from risk. It's looking to actually accept risk, create some alpha opportunities rather where it can, very tactically. We've talked about a variety of different places, financial sector, technology, healthcare, biotech, and I think you have to like that.
This is a Stephanie Link market. That's the way I'm looking at it.
It's been a good couple of days, yes.
It reflects your portfolio.
Yes, it does.
A little bit of tech and a lot of everything else. And that's very much where we are, because the S&P, as it does head towards 7K, it is doing it without some of the very biggest names taking it there. The equal weight is coming off a fresh record high of its own, and we know the areas in the market that have been off to the races to start the year. Banks, industrials, and all the stuff that you've been talking about because of the economy. And as one business executive said to me today, he's surprised with all of the business activities going on post-holidays, quote, like the floodgates instantly opened. That's kind of reflected in the market.
We talk about loan growth as being very, very important from the banks. And I cite this really wonky statistic from the H8 data from the Federal Reserve. It's just loan growth data. It's activity from the banks. We've had 11 consecutive weeks of loan growth. We're at record highs. And why do we care? Because if they're lending, then the activity in the economy is actually building. And that's exactly what we are seeing. We're at record highs in bank loan growth. 11 straight weeks, by the way, Scott, is at the best consecutive weeks since the second quarter of 2022. So banks are lending. That's good. The consumer has been spending. They're consuming. We're looking at retail sales. I look at credit card data. $1 trillion in holiday spending this past season. You have the AI momentum. You not only have the growth from AI, you have the food chain that's benefiting, and you have productivity that's happening. All of this leads to double-digit earnings growth. Is it going to lead to 16, 17%, like some strategists are thinking? I don't know. I'm going to point to you on that. I don't know, but I think 10 to 12% is very reasonable in a 2.5%, 3% GDP world, given all the things that I'm talking about.
You get the feeling from, both what you say and what I heard from the person that I was quoting there. It's like animal spirits were delayed, not denied. Coming into 25, everybody was like, I remember, late in 24, it was my conversation with Todd Bowley of Eldridge out in Beverly Hills was talking about animal spirits, and you had the Trump election and taking office, but then you had the tariffs, and it upset a lot of that. But now it feels like you may actually get what some thought was going to happen a year ago, and the market kind of reflects that if you look at the equal weight that's really doing great. What do you think, Liz?
Yeah, I mean, if we look at just cyclicality in general, we're almost hitting on all cylinders. All of the indicators that the market would give you for cyclicality, things like consumer discretionary outperforming staples. We had the value index hit a new high before the growth index. Some of the recovery that we had after that pullback in November. All of the cyclicality stuff is here, even in commodities, right? Copper is doing well. Gold obviously still doing well, but all of the stuff that would tell you economic activity not only is picking up, but is expected to stay strong. To Steph's point about consumer spending, I think that's a really important thing for investors to realize, is that despite the fact that we didn't have the year-end rally or the Santa Claus rally that we all hoped for, the consumer kept spending. Retail stocks should benefit from that. The economy should benefit from that. And I think sentiment will start to recover after the soft patch that we saw in the fourth quarter of 2025. So I am still cyclically bullish. I like materials for the year very much. I like healthcare as a place for investors to rotate into looking for growth exposure, and that continues to do well. And I just like how the market's shaping up, especially after a geopolitical shock coming into the year to kick it off with a bang.
You know, especially, Jason, when you had so much conversation last year about valuation of the market.
Yep.
Well, it's rich at 22 times.
Yep.
You're not going to get multiple expansion this year, so you have to have a really strong level of earnings growth to carry the market higher.
Yep.
If it's going to go higher. I love a note from Barclays today, which takes on the valuation question and comes back with the fact that they say they look reasonable to start off this new year. Quote, while 22 times is not cheap by any stretch, in our view, current levels have not historically impeded returns, provided EPS growth remains positive. While we do think that current street estimates are overly optimistic, we still expect the S&P 500 to print double-digit EPS growth this year. It better.
Yeah.
It has to.
No, it has to.
It has to.
It has
to justify that valuation, which may, in fact, grow a little richer.
And there's no doubt about it, Scott, that the earnings picture looks very positive, whether it's 12, 13, 14, 15%, somewhere in that neighborhood, I think, what we hear from strategists. And I think, the multiple on the market historically is not a great timing mechanism for markets, right? That's what we do know. And what I guess my impression of the market and what's been going on the early part of this year from a positioning standpoint and just the breadth that we've all talked about is this is durable. This is a healthy market. We want to see, to Steph's point, the other 493, the other sectors starting to perform, whether it's the KRE, regionals, financials, industrials, transports hit an all-time high the other day. So these are all positive momentum factors for me, and I think it spells to the durability of this market.